About the Silicon Valley real estate market, ending the week of April the 19th. We're going to be going over these key chapters. You can jump to the timestamp in the YouTube description. We're going to start off with some new slides. This is to show the impact of the tariffs on the Silicon Valley real estate marketplace, and if there is an impact, and I'll let everybody decide it themselves. But let me try to give you some insight on what's going on with these tables. We're looking at the number of offers accepted on a weekly basis. Normally, I look at 5 weeks, and I do that for stability reasons. And one reason is Easter. Easter moves around. In the last 11 years. It was once in this week between the 22nd and March 28th, which I would have reported on March 29th. 3 times I would have reported on April the 5th, twice on April the 12th, 3 times on April the 19th. So this is one of the common weeks to have it, and twice next week on the 26th. That explains why the blue line between this data point and this data point is low. So normally the line would be up like something like that. The Easter impact is impacting each one of those. Now, the impact from Easter is the week after Easter. And the reason for that is the activity that would be normally generated this weekend, Easter weekend, because tomorrow's Easter, is going to be reduced. And that shows up in the number of sales reported during next week. And then typically, the reason the data comes up is I normally look at it for 5 weeks. Now, this is weekly data. So this, once you're past the Easter season, it pops back up. So your real sales should be from basically this data point to, a data point like this. So it should be going in sort of like a straight line like this. Now, of course, it's not a straight line. But in fact, what's happened is this line here, the dark line that goes all the way from the top to the bottom, the Easter week range is these partial height lines. The full height line is when April 2nd was and the impact of tariffs. So you can see that April 5th, which is in my next data reporting, it really didn't impact data, and that makes sense. People went out the previous weekend before April 2nd, looked at the house, found the house, and committed to writing up the offer, wrote the offer, and in some cases got the offer accepted all before the presidential announcement. And then you can see we've come down, and then we bounced back up a little bit this week. Why you're bouncing from one week to another is anybody's discussion. But that's sort of the overall. This is Silicon Valley as a whole, so that's the 3 counties. It's also interesting now when we look at it county by county. If you look at Alameda County, but it came down significantly and bounced up significantly. If you look at Santa Clara County, the county that I'm currently in, it basically went down and it was flat. So a different pattern. It didn't rebound as Alameda County did. And then San Mateo County really didn't go down at all. How much of this is impacted? With the amount of impact on the stock market that we had, you would have thought that would have got people shook up. But anyway, that's what we're seeing in the data as of this point. It's 1 week data. I normally don't look at 1 week data. It took me a little while to get my head around what was going on, but I think that's an explanation. Moving on to the first summary chart. We have inventory, and right here is the current week. This is going back a quarter to the left-hand side, the actual level of inventory and percent of normal. On the right-hand side is the current level, and where you had the most inventory as surplus, what the typical level, and then whether you had a shortage. So we have currently 2,730 current active listings. That's 28% more than we typically do at this time of the year. You can see you're just above the blue line, just like last week, you were just above the blue line, a little closer to the blue line, it looks like this week than last week. Looking at the number of offers accepted, and this is going back for that 5-week period of time that I typically use versus the 1 week that I introduced at the beginning. And you can see the purple lines coming up between the blue and the typical line, the gray line. And you can see that currently we're at 2137. The number of offers we have typical is 2739. So we're missing almost 600 offers accepted. We're at 78%. That's basically unchanged from the 74 we were 13 weeks ago. Meanwhile, the inventory, if you go back up, you went from 93% to 28% above normal. So you've had a change of 35%. You've gained a third of your inventory, and you picked up none of the offers. The transactions have picked up a little bit from 75% to 86%. So they're a little bit higher percentage of normal. And you can see that because at the beginning of the quarter, a quarter ago, you were right on top of the blue line. And now you're halfway between the blue line and the typical gray line. Days on sold inventory. This is a seller buyer balance, the supply demand balance. It's the turnover rate. And you can see that the purple line is above the blue line. So we're having a fairly slow marketplace. You can see that we went from 117% of typical to 150% of typical. So we're 50% slower. And you can see in numbers, we're basically at 45 where typical is 30. So 50% of 30 is 15. 15 plus 30 is the 45. So you're 50% slower than typical. And also noteworthy is the 45 days that we're currently at is slower than the lowest 40 days that we've had in the past 10 years. And those 10 years are 2015 through 2024. Days on marketplace 75th percentile. I'm less of a fan of this indicator. I'm more of a fan of 75 percentile than average or median. Average gets thrown away by the one seller that takes forever to sell. The median doesn't fluctuate much. So if you're going to look at days on market, which sounds like a great metric, this is a much better measure of that metric. But I'm not a fan of it because it doesn't change very much and it sounds fairly aggressive. But anyway, you went from 90% of typical, so a little bit faster than typical at 38 days. Now you're only at 19 days, but that's actually 27% slower than normal. So you've had about a 38% slowing down of the marketplace measured by days on market. One of the reasons I don't like this metric is it only includes the sellers that are successful in selling. Right now we're at 19 days. The longest is 21. So you can see you're just below that blue line. Price reductions. This is sellers that are coming on the marketplace that then aren't able to sell their property and then eventually reduce their price in an effort to sell it. We were taking 0.7% of a price reduction. That was only 90% of normal, so 10% less than normal. Now we're taking almost 300, so almost 3 times the price reductions we want, but yet the magnitude of those price reductions is the same at 0.7%. It's just at this time of the year, you're typically taking very little price reductions. So the amount of price reductions has been fairly stable, but normally it's reducing and you get to the minimum amount about I guess that's about 5 weeks into the future. So price reductions are more common, and that would be something you would expect is if people put their house on the marketplace and then there was a change in the economy for whatever reason and the prices decreased, then those sellers that already went on the market would have to adjust their price. Sellers that are going to be coming on the marketplace in another 2-3 weeks from now, after people start to adjust to the current reality, those prices will be more in line with whatever the market conditions are, and therefore price reductions may reduce again in the future and in the near-term future. It all depends on how quickly agents and property owners that want to sell decide that the market is in a different place than it used to be, if in fact that's true. Moving down to overbids. This is what buyers are doing. Now, we don't know what the buyers are doing this last week or the week before because we have no idea what the sell price is until the escrow closes. But a quarter ago, 13 weeks ago, you can see we got 4.4% more than the seller was asking on average, and typical is 3.2%. And then you come over here right now, we're at 8 and it's over here because I didn't want to put it in the middle of the chart. So even though we're right here at this current week, you're still above the gray line, so you're more competitive. So we're at 8.3% overbid, and normal at this amount of time is 7.2%. So you're about 1/6 more overbidding than typical. Now we're looking at Silicon Valley as a whole. We're looking at the 3 key components, which is inventory. Inventory is the purple. It doesn't surprise me inventory went down this last week because a lot of sellers don't want to put their house on the market going into any holiday weekend. Easter is a fairly significant holiday. I would expect this number to turn around and go back up next week. That's not saying that the market will do that. That's what I'd expect. The sellers that would come on this week either accelerated and went on last week or delay and come on this week coming on the future. They'll start coming on mostly Tuesday through Friday is when you'll start seeing the bulk of the new listings coming on after Easter. The next thing is the number of offers. The number of offers here, you can see it, and this is a percent of normal. So this might be a better indicator. You can see we had been improving for the first part of the year. Basically, the low point was January 3rd. We improved from January the 3rd through about March 21st, maybe something like that. Then we sort of did a little correction for 2 weeks. And then we had the tariff announcement basically on April the 2nd, and then we come straight down. Now we went straight up, so the straight down isn't uncharacteristic, and we're still above the level, or we're right now at the level that we were in 2024, and in a good part of it, doing better than we did in 2023. So we're not talking about disastrous, but the concern that I would have is the steepness of this line. But you can see that this line changes very abruptly. So next week it could be up here, it could be down here, it could be sideways. We're basically got rid of the improvement that we were seeing first quarter of 2025, and we're lost that in a very short period of time. Basically, a couple weeks before the tariff, we went down basically 4 percentage points, and then since the tariff announcement, we've gone down 8 percentage points. Moving on to days unsold inventory, that's the gray line. Increasing number is a slowing marketplace. And just last week, we were up here in very rare territory. The only time that was slower than that was right here at COVID and the very end of 2018 when we had that weird marketplace in Santa Clara County. Mostly, I don't know if people remember, I think it was 2017 where we had a double round of appreciation, and 2018 started off strong and then died really weak. But we've turned around, and again, this is because the offers maintain typically going into a holiday weekend, but the number of new listings tend to go down, which improves your days unsold inventory. Next week, I would expect, but it's no guarantee that that will increase with the number of new inventory. There'll be a lot of new inventory and no time to sell it because there won't be a weekend by the time I come back next week. Here's looking at active inventory. You can see we just climbed very rapidly all this year, fairly straight up line. Here's the little correction for going into Easter. Again, I would anticipate based on this line and the fact that the lines typically, my typical gray line, my hot limited inventory red line, and my blue line are all going up at this time of the year. I would expect it to go up next week. If you're looking at, you're not seeing the Easter impact as much because there's the different weeks that Easter came over. It was 3 weeks this time frame, 3 weeks another, 2 and 2 and 1, I think are the numbers, if I remember right. It was out on that first chart down here in the lower right-hand corner if you want to go back and look at the numbers. Here's your active inventory compared to normal. So we were a lack of inventory at the beginning part of the year. We had a shortage. We were down here somewhere around 73% of the inventory you'd expect. Last week, we were all the way up to about 138%, maybe 137% of the inventory you'd expect. And this week, we're down to about 128% of the inventory you expect. So you have 28% more inventory than you expect, 128% of the inventory you'd expect. The green line here, the vertical green line, is to highlight the change in the x-axis. You can see how close together my quarter lines are here, the 3 quarter lines between the annual lines. Now they're much more spread out. It's about a 2x spread, and that's so you can see current trends. You can see that the number of offers came up. We got right to the April 1st, this beginning of second quarter, and the number of offers have come down. This is on the 5-week trend. So this is the more stable index. It's harder to see trend changes, a little thing. But again, look at the typical line. It's typically nice and smooth. Your hotter than normal, more offers is a nice smooth line. Now, if you come down and see the least, we're plotting the least number of transactions. That drops off because that's going to be registering Easter for a couple weeks. When you have Easter for 3 weeks, 2 weeks, 2 weeks, and 3 weeks, it's going to be a couple weeks of a low, and that's exactly what we're seeing here. So I'd expect this data point for next week to be significantly lower because that has 100% of the impact of Easter. Here's a percentage of normal. So you started off the beginning of the year at about 68% of normal. That's only, you're missing a whole third of the marketplace. We got all the way up to 90%, and we're now back down to 78% of the offers you'd expect to have in a typical year. Here's days unsold inventory. So the turnover rate of the marketplace, you can see we're higher than normal. We're sort of following the normal pattern. We had an abrupt change, I would actually say, before the tariff announcement, like 4 weeks maybe before. So that would have been somewhere right around the beginning of March. We came up, we started having more inventory relative to the sales. But then there was this abrupt change last week, and then a leveling off this week. And again, the leveling off this week is mostly artificial. It's that you didn't have the new inventory coming on the marketplace. So when you had the same number of buyers buying, they drove up a bigger chunk of the marketplace. So it sort of leveled off. I'd expect next week with a flood of new inventory with no ability to purchase because sellers are going to hold on for 10 days from now before they look at offers. I'd expect this number to be up significantly next week. Here's versus typical. Look at the slowdown. And if you want to look at this, and this is sort of, I think, sort of telling, even though the number of offers picked up and those kinds of things, if you look at the ratio between the two, the turnover rate, basically since January 1st, this has gone straight uphill, which is a slowing down of the marketplace. We went from some number around 93% of normal, which would have been a slightly faster than normal marketplace. A good part of the fourth quarter of 2024 was done at faster than normal, a fair amount of movement though. And then we just slowed right down. And yes, there's been a few jags, but if you go straight up like that, that's pretty scary. So the market has slowed down dramatically, and the slowdown in the marketplace, as measured by days unsold inventory, occurred clearly before any tariff announcement. Here now is looking at marketing time for the 75th percentile sellers. I pointed this out before. if you expect the typical line, you had a shift here of about half a quarter, so about 6-7 weeks. Now you come down here, and the bottom of the marketplace is usually mid-quarter. So now your shift in the marketplace has been a full 13 weeks, and we're clearly taking longer to sell. This slowdown is fairly close to the typical slowdown you have, but that slowdown for the typical doesn't start happening until beginning of third quarter. And here we are basically beginning of second quarter, going down a pattern that looks very like the beginning of third quarter. No idea why that's happening, just an observation. And my data is accurate the best I can tell, and I've checked on it fairly carefully. Here's the percentage of normal. Look at the rocket ship ride. We went way down. Now, this could be not necessarily that the market was better. This could simply be we were having more than the normal number of listings coming on the year after the New Year's with 0 days on the market, and that would be what would sell. That would reduce your time. So we got down here to the middle of first quarter at a record slow marketing time, and now we're up here, and we're not at a record high, but we're approaching 30%. It's longer than normal, and the number of times you're above that 30% is very limited. You have 2019, you have 2020 with COVID, you have a little bit in 2022 and a little bit in 2023. So very limited time at a longer marketing time than we're currently are at. And this is comparing the current marketing time to what typical based on the past 10 years. And again, those 10 years that I'm using are moving 10 years. So they're currently 2015 through 2024. I don't use the current year in the 10-year median. Here is the sellers that take the 10% of the sellers that are taking the largest price reduction. What are they taking? So the 95th percentile is right down here, and they're taking somewhere around 10.5% price reductions. So that becomes pretty significant. If you have $1 million house, that's $100,000 price reduction that you took. And you can see that the price reductions right now are more than typical. This is about the time of the year when they're the least, and we'd start expecting them to start increasing fairly soon. And I would expect that to happen based on other indicators. And so I'd expect the purple line to be below the blue line going forward. Here's the compared to typical. So you can see we were taking less price reductions than normal halfway through first quarter, a third of the way through first quarter. Then all of a sudden we started taking more and more price reductions. This last week we took a correction, and I believe that's mostly again because of Easter. If you're a seller that's on the market that isn't selling, you're not going to want to do your price reduction going into a holiday weekend when there's going to be fewer buyers to observe that holiday price reduction. Here's average, and I include average simply so that you can see I'm not doing anything unusual with my 10 percentile. We went straight up, we came down, and then we came down significantly since April 2nd. So if you look at this line being April the 2nd, more or less, because it's for April 1st, and I think my Saturday would have been April the 5th. And it's also possible that buyers that negotiated a contract on April 1st may not have ever done what they promised to do, may not have submitted their earnest money deposit into escrow, and that would have caused that transaction to fall apart. And that may be why it looks like the data actually backed up a week. And we sort of saw the same thing on the pandemic. And I don't know if we can pick it up here, but let's see if we can. I guess price reductions aren't going to show up in the pandemic because the sellers weren't able to sell. It was more the activity, the number of offers that was really impacted when we had the COVID shutdown. Here's the ask price reductions. So you can see the dramatic change from basically a third of the week. So 4 weeks into the year, we changed from improving to a decreasing marketplace, then a sharply decreasing marketplace right around April the 1st. We had a slight improvement this last weekend, but again, it's my speculation that the reason we had a decrease in the price reductions is if I was a seller, I wouldn't want to take my price reduction going into a holiday weekend when I expect fewer buyers out there. I would have done it a week earlier or a week later. This is looking at the frequency of price reductions. So price reductions are becoming more frequent. They were sort of already turned around, and basically on April the 1st, they went up fairly significantly. They went up from only 9% of the sellers doing a price reduction up now to something like 12% of the sellers are doing a price reduction. So not huge numbers, but as you can see, it's a marked increase, and that increase happened a little bit earlier than it typically does. You can see the U-shaped here. The U-shaped here is happening typically right at the end of first quarter, end of first quarter, not halfway through first quarter. Here's the frequency compared to normal. So now you're at 50% more frequent price reductions. So if you had 5% of the sellers doing price reductions normally, a 50% increase would be up to 7.5%. But anyway, you can see again the significant increase compared to normal in price adjustments. This is the overbidding. This is a lagging indicator, but it clearly turned this last week and is now, it appears to be in a downward direction. Holidays isn't going to impact this because it's more the lagging indicator, because you had a duration of escrow, and that duration of escrow is typically about 5 weeks. And so this is what happened 5 weeks ago. And a holiday, when you're reporting the sold price, may delay you by 1 day, but isn't going to delay you for a whole week. So anyway, the magnitude of overbidding is clearly peaked at 6% overbid. And this is the median overbidding. And now you're at 5.5% overbidding and coming on the way down. This is the magnitude of overbidding compared to normal. So you can see we were higher than normal overbidding here. And we were actually somewhat in rare territory halfway through, 2/3 of the way through first quarter. And now we're down definitely into normal territory. We're not normal yet. We're still a little bit above normal, but only 1% above normal. And that's 1% of the sale price. So if it's $1 million property, that would be $10,000 more overbidding than you'd expect. This is the frequency of that overbidding. You can see that we turned around when you normally do. We're just slightly above typical. And we turned around and went down basically right here, right at the end of first quarter, beginning of second quarter. You want to call it April 1st, that's fine. That's basically when it was. Was it associated with the tariffs? Again, no, because this is data that's going to lag by 5 weeks. We're not going to see any tariff impact until the beginning of May at the earliest. Here's the frequency of the overbidding. So you can see we were more common overbidding than typical. Now we're actually below, and we have less common overbidding. Now, granted, it's pretty close at about 98.5%. So you're only 1.5% less overbidding than you'd expect. And this is the frequency. So how common is it? Here's pricing. I had been doing a one line through here at 10.9% appreciation since the last 9 months of 2015. I changed it to closer to 12.5% for the first several years, and then like 3.33% for the last couple of years. But right now we're up higher. But notice that last year we turned around. Every year you turn around. So I'd expect these prices to level off and turn around and come back down. Now I may have to adjust this line, the 3.3% line, up slightly, but I suspect not that much after we come down off the peak. I don't look at this overshoot. This is people getting excited in the hyper that we have every year in Silicon Valley marketplace. You can see every year you have that. Here's looking at the distribution, and we're looking at days on marketplace. The purple line is the current line. A year ago, we were down here. So the market is clearly significantly slower. And just a real quick demonstration, here's the 75th percentile. So you can see the difference, from 16 days to something like 20 days. That becomes noticeable. You come down here, and if you use the median, you're going from something like 14 days to maybe 15.5 days. Much harder to see changes in the marketplace. By having the distribution, you can see, and these sellers that are taking the longest time, the amount of increase is biggest. We're going to jump through 1 week at a time, initially for 5 weeks. Then we jump at 2 weeks at a time, and then we jump 1 week at a time at the end. So there you go. You can see you went down for another week, and then you sort of started to slow down. So that would be where you'd expect the market to go. So again, from the purple line, we've already started to slow down. So I'd expect it to slow down. Here's the summer doldrums where you're just sort of bouncing around. And then right after Halloween, I'd expect it to start increasing like it just did. And they're sort of the slowest for the year. Now you start accelerating rapidly. And they're sort of the peak for the year, the slowest marketing time, the quickest market time. And here you can see you're climbing. Same concept for largest price reductions. You can see that a year ago, we were basically having the least price reductions, pretty good. Yes, we had 1 year up here on the dotted line. You can barely see underneath the solid line. But this year, you're down here. So you're taking quite a bit larger price reductions this year. And you had another week of slower. And now you're coming down and you're taking larger and larger price reductions. That's about where we are. So we're already about the middle of July, beginning of July. And then you sort of do the summer sold doldrums. And then right after Halloween, right about now, you start expecting drops off. And now it's less and less price reductions as you get into the new year. We're right about the peak, and then you start slowing down. And then, so you've already peaked out this year and coming back down, even though last year this was looked like it was the peak year, because I'm not a peak week. I'm not seeing a week above here. So you're taking larger price reductions, more frequent price reductions. You can see that basically 12.5% of the sellers are doing price reductions now, where last year was only 7.5%. You come down and read it off the x-axis. Here's the same thing with overbidding. Now, again, remember the lag time, But again, the purple line, the current line, is quite a bit cooler than the dotted line, which is a year ago data. And not quite at the peak. There's the peak right there. So about 3 more weeks, and then you have a plateau, and then you come back down. Here's the summer plateau, and because of the 5-week delay time, the drop off happens right after Thanksgiving or close to Thanksgiving, not close to Halloween. And right there, it looks like it starts. Yep. So there's sort of the bottom of the marketplace, and then first of the year it races up, and now you've already plateaued, and there's the current week. Inventory in all 3 counties is going up. You can see it drop down a little bit in Santa Clara County and a little bit in Alameda County. And again, that's because a lot of sellers aren't going to want to market their property going into a holiday weekend. I try to avoid it when I can. Here's offers accepted. Offers accepted went down, and it's peaked in Santa Clara County basically on the week of April the 5th. It peaked in April the 5th in Alameda County. San Mateo County is clearly doing it differently than those 2 counties, and it's continuing to see an increase in the number of offers. That's why it's important to look at a lot of data to understand. You can't just look at Santa Clara and Alameda County and say that's what Silicon Valley is doing, because San Mateo County is clearly doing something different. Here's days unsold inventory. So the speed, Santa Clara County is the fastest at 38 days. San Mateo County is next at 40, and Alameda County is the slowest at 55 days. And we'll see later, I believe, that's interesting. The slowest county, Alameda, may have the highest amount of overbidding. Here's the marketing time. Again, Alameda County's got the longest marketing time at 22 days. Santa Clara County and San Mateo County are essentially tied at somewhere around 16 days to market the property. Santa Clara County went down and came up, and San Mateo County has been absolutely flat. Here's the magnitude of sellers' price reductions. So even though Alameda County had the longer marketing time that I pointed out, it's got the least amount of price reductions at 0.5%, followed by Santa Clara County at about 0.8%, and San Mateo County is taking the most at 0.9%. So that's less than 1% price reduction. So it may not sound like a lot. We tend to do our homework before we go in the marketplace. And this is the frequency of price reductions. You can see they're climbing in all 3 counties. Santa Clara County was probably the first to climb. Alameda County was the second. San Mateo climbed early, but then improved, and then it slowed down. But all 3 are pretty close together. San Mateo County is the least at about 10.5% of the sellers doing price reductions. Santa Clara County is next at just under 12%. And the most price reductions is Alameda County at just over 12%. Here's the overbid. This is the average magnitude of overbid. Alameda County, the slowest county, it has the most overbid, 9% overbidding. Santa Clara County has the least overbidding at about 7.75% overbidding, and San Mateo County is about 8.25%. This is the frequency of overbidding. All 3 counties are very close together at around 72 to 74% of the sellers getting more than their asking price. So you're approaching 3/4 of the sellers are getting more than their asking price. But again, this is a lagging indicator of 5 weeks. Long-term appreciation, Santa Clara County has clearly got the highest appreciation rate at 120% appreciation since the last 9 months of 2015. Alameda County is next at about 84% appreciation. And then San Mateo County has the least amount of appreciation at something like 67% appreciation. Here's the median sold price. Look at the drop in San Mateo County this last week. That's a pretty significant drop. Why it dropped so much in 1 week is hard to understand, especially when I use 5-week moving average. So 80% of my data is the same, but it changed in 20% of the data. It really pulled down the median. I did not have time to dive into the data to verify it, but I have no reason to believe that's wrong. And there have been significant week-to-week drops in the past in San Mateo County. It's a smaller county, so I think it's just a matter of what happened to sell. Santa Clara County has the highest median sold price now. It's something like $2.1 million, and Alameda County is the most affordable at under $1.4 million. Here's the same information on regular paper. The previous was on the logarithmic paper. Here's the estimated payments for the 3 counties. I'm working on getting it back for the other slides, but you can see the payment dropped in San Mateo County along with the price caused by the price, as interest rates actually jumped almost a full 0.25% on the national average. Moving on to the heat maps, we're looking at active listings compared to the 10-year median. Blue in color favors the buyer, so that means that we're having more inventory at this time of the year, and the bluer the areas, the more inventory compared to the 10-year median. And in 10 years, I'm comparing it to 2015 through 2024. I do not use 2025 in my 10-year comparison. That would be the 11th year. So you can see that you have some areas of significant blue down here in the southeast area of Santa Clara County, Redwood City, and Daly City, Pacific area of San Mateo County. A good part of the Silicon Valley is a pale, very pale blue. You can see the ranges over here. The next several charts are all the same. So you got Silicon Valley overall has got 28% more inventory than you'd expect. Santa Clara County has 23%, and then the micro market areas within Santa Clara County range from a shortage of 81% in Santa Clara County, which is a 19% shortage, to a 54.5% surplus in Milpitas Berryessa. You go down to San Mateo County and they actually have more inventory at 135% of expected, from a low of 93% to a high of 102 thirds, so 167% in Redwood City. And then you go down to Alameda County, where I don't have, for the first three slides, I don't have the micro market data, so you only have countywide data of 132%. So overall, as you can see from Santa Clara, from Silicon Valley, you have that 28% surplus of inventory. Looking at the same concept with the number of offers, you can see Silicon Valley's got 78% of the inventory you'd expect, and that's a pretty close metric. You have 78% in Santa Clara County, 96% in San Mateo County. So San Mateo County has almost the normal amount of number of offers accepted based on the past 10 years, and Alameda County is at 72%. So the real standout, and it doesn't pull up the number much, is because it's so small, is San Mateo County. And the range in San Mateo County is anywhere from Redwood City, which has only got 2/3, it's missing a third of the marketplace in Redwood City, to San Carlos, Belmont, and what I call the Bay Cities, where it's only missing 8% of the number of offers. Days unsold inventory is the ratio between the turnover rate, the supply-demand balance. You can clearly see some bright blue areas here, deep blue, Redwood City's deep blue. So overall, Silicon Valley is 50% longer than normal. So it's taking 50% longer to sell out your existing inventory. Santa Clara County is 42% with a range of 76% in Palo Alto. So Palo Alto is actually moving quicker than it typically does for this time of the year. Then you go down to areas like Morgan Hill at 83%, slower than normal. So quite a range in Santa Clara County. San Mateo County is 30% slower than normal, with a range of 7% slower than normal in the expensive areas, to a high of Redwood City. So Redwood City is the real standout, of 2.5 times slower than normal. And you can see how deep blue that is. It's deep blue, like Milpitas at 2.25. Then you go down to Alameda County and it's I don't have micro market area data, so it's slower and at 57% slower than normal. Nowadays, unsold inventory is compared to just normal. So it's just the raw number now. It's not comparing to anything. Basically, your range is from 1 week to 6 weeks. It's a fast-paced market. So if you could sell everything in your marketplace in 6 weeks, I would consider that to be a fast-paced market. From 6 to 11 weeks is a normal pace, and anything over 11 weeks is starting to be on the long side. So Silicon Valley is at 45 days, right there in the low, at the fast end of normal. The range in Santa Clara County is at 38 days, so just barely into a fast-paced marketplace, and you can see a little bit of pink. And the range is anywhere from 23 days in Cupertino and Sunnyvale. Campbell's not far behind at 30 days. But then you also get up to areas like the Morgan Hill at 72 days. And to be fair, Morgan Hill and Saratoga Las Vegas tend to have longer marketing times. So in some respects, the affordable areas of Santa Clara County, East Central and South San Jose at 46 days is probably the longer marketing time. San Mateo County's overall 40 days, which is pretty reasonable, right there at the balanced marketplace. The fastest time I'm seeing is in Foster City, very, very small micro market area, so we should probably even ignore that. So that brings you up to the Bay Cities at 31 days, all the way to as slow as 76 days in the expensive areas. San Mateo County coast is right there at 76 days as well. And in Alameda County, we have micro market data for the first time, 51 days overall. The fast I'm seeing is Castro Valley, Dublin, and Livermore at 40 days. And the long one that I'm seeing is in Hayward at 98 days. Moving on to marketing time, this is how long is it taking 3 out of 4 sellers to sell their properties. From 1 to 3 weeks, I consider to be fast. From 3 to 6 weeks, I consider to be typical. And anything over 6 weeks is a slow marketplace. And this only measures the successful sellers. So the sellers that come on the marketplace and don't sell, or take a real long time to sell, really don't impact this data, because they're in the 25% that takes a long time to sell. And that's why this is sort of a tight metric, tighter than days of unsold inventory. Silicon Valley overall at 19 days. So rapidly approaching what I would consider normal. Santa Clara 16 days, so that's a little bit fast. a slow of 13 days in the Campbell area as well as Cupertino, and a long time of 31 days in Saratoga and Morgan Hill. So two areas at the very high end. You got three areas in the short end because Berryessa at 14 days is right there. And then sort of in the middle of the pack, you have the affordable areas and also Los Altos, Palo Alto. San Mateo County is at 16 days, a fast of 12 days in the Bay Cities, a slow of Half Moon Bay. And then after that, you come down to Pacifica. And then after that, probably Redwood City at 15 days, although the expensive areas is in between at 19 days. And then Alameda County, again, micro market data is available. Overall, 22 days, a range of 15 days in Fremont to a high of 32 days in Oakland. Most of Alameda County is between 15 and 21 days, so pretty tight marketing time in Alameda County. This is the magnitude of sellers' ask price reductions. Overall, Silicon Valley is at 0.7%. Santa Clara County is at 0.8%. And you can see the range isn't very much, anywhere from a low of 0.3 in Cupertino, Sunnyvale to a big of 1.4 in Morgan Hill. So the range is only 1%, and 1%, of $1 million is only $10,000. So it's pretty tight. San Mateo County is very similar at 0.9%. You can see the range is from a positive of 0.1%. But again, that's a pretty small micro market area. So even though Redwood City had a long marketing time, they're at 0% price reductions. And then you have a long of 1.9 in Atherton, the expensive areas. And Alameda County is a 0.5% price reduction, anywhere from 0.3% increase in Berkeley to a 1% decrease in Castro Valley and Dublin. And Castro Valley, Dublin, and Livermore actually had a fast marketing time, if I remember correctly. Looking over the ask price reduction, this is the frequency. The previous slide was the magnitude. So in Santa Clara, Silicon Valley overall, you have basically 11.7%. That's exactly what Santa Clara County has. Range is from a high of 23% in the affordable areas to a low of only 3% of the sellers doing a price reduction in Cupertino, Sunnyvale. San Mateo County is at 10.5%, and that range is from a 2.6%. So again, in San Mateo County, Redwood City is doing very few price reductions, but a very long marketing time. And then the biggest decrease that I'm seeing is the San Mateo County coast at 17% of the sellers are doing a price reduction. Alameda County is at 12% overall, and the range is from 4% in Berkeley up to a large of 19%. So basically 1 in 5 sellers in Pleasanton are doing a price adjustment. This is the frequent magnitude of the buyer overbidding, 8.3% overall in Silicon Valley. In Santa Clara County, very similar, just off. One's a little under, one's a little over. And then again, the range and the concept's the same as the previous slides, 8.2% in San Mateo County and 8.9% in Alameda County. Alameda County has the most overbidding with one of the longest marketing times, which is not what you would expect. You expect if it's taking a long time to market, more sellers would be doing price adjustments, and then buyers would be coming in and negotiating the price down. What could be happening is buyers are waiting for the seller to reduce their price, and then the seller overshoots where the market is, and then the buyer comes in and overbids the seller's new asking price. This is the frequency of overbidding, basically 0.75%, 73% in Silicon Valley, 74%, 73.5% in Santa Clara County, 74.5% in San Mateo County, and a 72% in Alameda County. The range is anywhere from 42% in Alameda County. That's overall the least amount of frequent overbidding, and the highest overbidding that I am seeing is 84% in Pacifica. And that's also interesting because Pacifica has a pretty long marketing time too, if I remember correctly, and to have a lot of overbidding. So maybe the same thing. Now I'm just noticing Cupertino, Sunnyvale here is a little bit higher at 92% overbidding. So almost every seller is getting more than their asking price in Cupertino and Sunnyvale. This is long-term appreciation since the last 9 months of 2015. You can see that the Silicon Valley is at 101% appreciation. So you basically doubled your money. Santa Clara County is 121%. San Mateo County is the low at 67%. So they haven't quite doubled it. They've only got 2/3 of their money back. And you can see all of San Mateo County is really blue. You can see on the map pretty interesting on how it's really centered in the Northwest Peninsula area. Silicon Valley is where the least amount of appreciation, and the most is sort of in the south and the east segments of Silicon Valley. And then in between you're spattered. Hayward's also a noticeable exception in having the lower price appreciation, as well as Oakland. And on my pricing, sold price, I follow just the median in the middle plus the low price on the left-hand side and the high price on the right-hand side. So you get a range. So in Silicon Valley, if you're looking for a single family home, you can find things from anywhere from $900,000 up to 3.7 million, with the median being 1.7 million here in the middle. And you can do that for each one of your micro market areas. Here, the red is simply the more expensive area. So the most expensive area I'm seeing right off the bat is Atherton at $4.8 million, with a range of $2.5 to $10 million. Los Altos is similar. Its low end is actually a little bit higher at 3 million. The median is a little bit lower at 4.5, and the high end is quite a bit lower at only 7 million and 7.5 million instead of 10 million. But that gives you a range of prices to expect in each one of the micro market areas. Here's a summary chart. So here you can start off on the left-hand side and pick the geographical area you're looking in or selling in, and then see what the micro market conditions are across the top. Or you can come over to the right-hand side with your budget and figure out what price range you're in, and then come across and figure out what geographical areas those prices are most likely going to be in. Silicon Valley is separated up here at the top, and then you have Santa Clara County on the top and micro market areas, San Mateo County, and then the micro market areas, and Alameda County and the micro market areas. And for Alameda County, for the first 3 slides, the data is the same because I don't have micro market data. Here's simply looking at the number of offers. We've gone back to the second lowest at only 2,050 transactions. The record low was back with the pandemic, which we can almost ignore at 1215. It's hard to sell a property when you couldn't show properties. And then you had 1,800 was the lowest normal year. And then after that, we have this year. So this is really the second lowest normal year if you ignore the pandemic. Similarly last year, but last year we had 2,154 transactions. This year we have 2,172, but very likely this 2,172 will drop with transactions failing over the next couple of weeks. And there's a very good chance we'll go below the 2,154. But basically the real thing is not the last 10 years, because that's when we've had all the low sales. But in the last 25 years, we're having the second and the third lowest number of transactions out of 25 years. And that's where I think it becomes somewhat significant. Here's the actual raw numbers you see for Santa Clara County, San Mateo County, and Alameda County, or Silicon Valley as a whole over on the left-hand side. Some of the key takeaways is the number of new listings is basically flat. It's a little bit down, which makes sense. Typically, sellers don't go in on the marketplace going into the holiday weekend, and this is obviously Easter weekend. The number of overall active listings is down roughly the same percentage. The number of offers is down a little bit higher, 1.5%. The speed of the marketplace is increasing overall, not very much. Half the day is pretty flat. I start getting worried when you see shifts of 5 days in a week. Marketing time, whether it's days on market median, average, or 75th percentile, and I prefer, as you guys know by now, the 75th percentile. Sale price and appreciation. And then I have appreciation since the last 9 months of 2015, as well as the appreciation over 2020. So I take 2020 as a base year, and also I take the last 9 months of 2015 as a base year. We've been talking about the Silicon Valley real estate marketplace. We will next be talking about the Greater Bay Area, 13 counties and 5 regions. If you type in the blue YouTube link, you get to my archive channel, or you can type in the shorter green root URL. The shorter green root URL becomes useful in the fact that you get to the live presentation Saturday morning at 9 a.m. by adding 2025 to the end of it, whatever year you're in. You get to the handout by the green root URL, the letter H for handout, the year 2025, the month 04, and the date 19, and you get today's PowerPoint presentation handouts in a PDF. And you can also get directly to any past episode by typing in the green root URL, the year, month, date code you're looking for. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is here, representing buyers or sellers in single agency transactions. And I would appreciate it if you would like the videos that you watch and subscribe to the channel if you haven't already. It doesn't cost you anything. And let's move on to the Greater Bay Area. These are the 5 regions. We've been talking about Silicon Valley already in detail. I often refer to San Francisco as the cities. North Bay is the 4 counties, Central Valley 2, and the Central Coast being 2. Here is the slides, very similar to where we were starting off with the 3 counties. You have the condensed scale to the left of the green line, the expanded scale 2x to the right of the green line. You can see that inventory has been growing in all the regions, down a little bit in Silicon Valley and down a little bit in the cities. The other regions are still going up, which is a little bit unusual. Typically, I would expect inventory to go down going into a holiday weekend just because of the number of new listings being down. The number of offers typically does not go down into a holiday, it goes down after the holiday. But you can see Silicon Valley is the most impacted since April 2nd on the reduction in the volume of offers being accepted. Central Valley is down a little bit, Central Coast is down a little bit. But if you look at the cities and also North Bay, they're going up straight up with no downward trend at all. So it's interesting to see the different regions, whether you can argue that people are more impacted by stock in Silicon Valley, and that's what's causing the downturn here. But people in the cities, San Francisco and Marin, I would think would be in stock too. And the Central Coast, at least, would be, it's still tech savvy to some degree, but, there's a lot of retirement homes, there's a lot of vacation homes, there's a lot of other types of properties going on there. So for it to be impacted by the stock market and North Bay not to be doesn't make sense. So I don't know why you have three regions that are going down and why the downturn is even significantly different. Silicon Valley is down significantly the most, and then Central Coast is down the second most, and then the Central Valley is down the third, and then I would call that flat. Meanwhile, the cities and the North Bay are going up, more and more offers being accepted. Here's the speed of the marketplace. So now you look at the ratio between the active inventory as well as the offers accepted. You got Silicon Valley being the fastest and being tied with San Francisco, the cities. San Francisco is decreasing, improving, turning over the market more rapidly, while Silicon Valley is decreasing, taking longer to turn over the market. So they're going in opposite directions. Right now, they're at the same level at roughly 45 days to sell out their existing inventory. The other three regions, being the Central Valley, the Central Coast, and the North Bay, are pretty close together on basically on both sides of the 70, going from 65 to 75 days of unsold inventory. Here's marketing time for this 3 out of 4 sellers, the 75th percentile, clearly increasing in Silicon Valley and has been for some time, basically since 2/3 of the way through first quarter. Cities is clearly flat. North Bay is flat. Central Coast is increasing, so taking longer to sell the property, but Central Valley is decreasing, taking less time to sell their properties. Here's the ask price reductions that the sellers are taking, down in Silicon Valley, down in all 5 regions. So here we finally have an agreement, down in different degrees, down since almost a third of the way through first quarter, it's been going down, more frequent price reductions. This is the magnitude of price reductions. 100% would be no price reduction. Normally there is some price reduction. That's why I drew the line here at a 0.5% price reduction. You can see that Silicon Valley just went over that and was taking slightly less than 0.5%. And then basically starting at the second quarter came down significantly from that 0.5%. It's currently now at about 0.75%. Cities has been coming down, but they both predate the quarter change. The Central Coast changed right at the quarter. The Central Valley here is basically flat, and the North Bay is coming down since before the quarter change. This is the frequency of sellers' price reductions, so how common are price reductions? It's turning around in 4 out of 5 regions. The region that hasn't turned around yet is the Central Valley. It's basically flat with somewhere around 26% of the sellers taking price reductions. Clearly, the cities in Silicon Valley are taking the least amount of price reductions. Down here, it's somewhere around 12 and 13%, so not very common. Even 1 in 4 sellers isn't very common, which is where the other 3 regions are. All of them are seeing more frequent price reductions. So the sellers in recent weeks have been overly optimistic compared to where they normally are. Here's the buyer overbidding. This is a lagging indicator because we need to get the sold price. So it lags by the duration of escrow, which is approximately 5 weeks. You can see it rolled over in Silicon Valley and has clearly come down, not significantly. You're talking about from about 9% to about 8.25%, so less than 0.75% price reduction. And so the cities appears to be in downward trend, but it's bouncing all over the place in part because there's less inventory up there. But it's gone from 10% down to 9.5% overbid on average. So this is the average. Sometimes I've used median on overbidding. Sometimes I use average. North Bay is flat at somewhere around 1.5% overbidding. And both the Central Valley and the Central Coast are below the seller's ask price. And that would be about 1/4% below the seller's ask price for those 2 regions. This is the frequency of overbidding. So how common is it? Most common in Silicon Valley at about 73.5% of the sellers are getting more than their asking price. Cities is at about 68%. Then you come down to North Bay where you only have 47% of the sellers getting more than their asking price, so less than 50. Central Valley at 40% and Central Coast at 36% of the sellers. So still more than 1 in 3 sellers are getting more than their asking price in the least overbidding area of the Central Coast. Here's the long-term appreciation since 2015. Silicon Valley's got the most appreciation up here at around 102%, and that's for all 3 counties. Then you have the Central Valley at something like 92%. Central Coast is bouncing all over the place, but currently at about 86% appreciation. North Bay is somewhere around 68%, so 2/3 of appreciation. And the area that's doing the least well and has been doing the least well since the pandemic is the cities area, just at 52% appreciation for 10 years. Now we're looking at the median sold price for the 5 regions. The most expensive region is the cities, up here at about 1.8 million. Yeah, 1.8 million, followed by Silicon Valley at about 1.750 million. You can see Silicon Valley is increasing. The cities has gone down this last week. Central Coast is rebounding and is currently at about 1.150, so $1,150,000 for their median sold price. North Bay's been pretty flat, been fluctuating around and currently at about 800,000 for their median sold price. And the most affordable area is the Central Valley at somewhere around 550,000. Here's the numbers. What you're doing here is you're looking at the current value of active inventory. You're comparing that's down 1.7% from a week ago, but it's up 21% from 5 weeks ago. So you can get a sort of a range of the different areas, the number of active listings, number of offers, the DUI, the median days on market, 75th percentile days on marketplace. So you can see how the difference, only a 25% swing, is 16 days for Santa Clara County, but 23 days for the 75th percentile. And just there's no change from a week ago. There's a 1-day change. So and then from 5 weeks ago, there's a 3-day increase, and here there's a 6-day increase. So you can see that by just moving up to the 75th percentile, you have more fluctuation. Seller price reductions, the magnitude, average, the frequency of those price reductions, then moving over to the sold price average magnitude, and this is a lagging indicator, which is why the orange, frequency of overbidding, and the sale price. So you can see where the prices are going up or down. It gives you just a lot of data, not easy to read format. These are the chapters that we've been going over. You can jump to the chapter you want that's most interesting for you. With that, not seeing any unmuted mics. Have a great week. Take care. Bye. Thanks for joining.